Hey guys, if you've paid any attention to the stock market or you are into investing, you've probably noticed one thing. And that thing is that pretty much every individual stock, ETF, or even cryptocurrency is struggling right now. And most of the market has been red for about the past week. And it's frustrating because more than likely you're doing all the quote unquote right things, and yet it just feels like you're going backwards. And this is the time where it's easy for all of us to get discouraged. You start wondering, well, should I stop investing? Should I move my money somewhere safer? Am I doing something wrong? Should I liquidate? Should I take profit? But here's the thing, market downturns are not just normal. They are just necessary parts of the moving stock market. And if you understand what's actually happening, you can use it to your advantage instead of letting it scare you. So every few years, the market goes through a down period, and even yearly, there's weeks where it goes pretty good up, but then there's also weeks where we see major pullbacks. It's just part of the normal cycle. Prices go up, then they come down, then they go back up again, probably higher than they were before. And if you look at any long-term chart, 2008, 2020, 2022, it all tells the same story. People panic, prices drop, then a few years later, those same people wish they had just done nothing but buy more. And it's hard to see that when you're in it, but zooming out will put everything into perspective. The market doesn't just move in a straight line. It moves up and down in different waves, and you kind of just have to ride the waves without jumping off. And a lot of the times too, a lot of people will get nervous seeing how the market has this massive downturn, and once again they'll start to think to themselves, what am I doing wrong? But you are not doing anything wrong. This is just a normal part of investing. And when you hear the market is down, it doesn't always mean that something's broken. A lot of the time, it's usually just investors reacting. And investors react to a lot of different things. They react to inflation, interest rates, politics, earning reports, just news outlets, and a lot of short-term moves are very emotional. Long-term trends, though, those are the logical things that we need to look at. Look, at the end of the day, companies are still selling products. People are still working, spending, and building things. The global economy does not just shut off because stocks go red for a few days, a few weeks, or a few months. And the market just prices in fear. And right now, the market's very scared, and that's really all that's happening. And the key thing to take away from this is downturns are where the real wealth is built. Everyone wants to buy into stocks when everything looks good. When prices are up, everyone's confident, everyone thinks they know what they're doing when it comes to stock picking, everyone's excited. But that's not how you truly build wealth. You build it by buying when it's uncomfortable and everyone else is fearful. If you're investing long term, right, 10, 20, 30 years, then a downturn to anyone is just a discount. Now, granted, if you're investing and you plan to retire very soon, or you do a lot of, day trading, then it could mean a little bit different to you. But at the end of the day, you're buying the same companies, the same index funds, and the same ETFs, just at a cheaper price. Just because Meta has dropped 30% over the last, week or so, that doesn't mean Meta's not the same exact company it was a week ago. It's the same exact company, but now on a 30% discount. So imagine having your favorite brand, a 20% off sale. You wouldn't run from it. You'd load up on everything you like from them. And the logic applies to the same stocks that you like to pick. The difference is, in the stock market, those quote unquote sales come wrapped in fear. So you just have to be the one who kind of sees through it and stays the course. We also just need to stay consistent, even when it hurts. The most successful investors are not the ones who time the market perfectly because theoretically that's impossible. They're the ones who are just consistent, even when it sucks. Dollar cost averaging through the downturns, buying the dips. Dollar cost averaging through red months is sometimes what separates consistent builders from just emotional traders, and that can make you a lot of money over time. And if you've been investing, let's say like every 2 weeks, keep doing it. If you have, got a Roth IRA or a 401k, keep contributing. I don't believe that these types of downturns, once again, assuming you're investing for the long-term future, are ever reasons to pull back on your investments. And the shares you buy when the prices are down, well, that's where all your compound interest is going to come from when the market recovers, and that's where you're going to see massive gains. And every bad month that you stay consistent, well, that you're just going to thank yourself later, because once again, that's where you're really going to see those gains start to turn up. So, in my opinion, one of the best things you can do during a market downturn like this, where we've had a few days of red and some uncertainty in the market, the best thing you can do is just stop looking at it. And I'm being dead serious. Don't log into your investment accounts, don't look at the market, don't do any of that. Watching your balance drop every morning does nothing but stress you out. And I know there's people that, a 3% loss to me is not a lot, but a 3% loss to someone else might be tens of thousands of dollars. So you don't want to stress yourself out, especially if you have the time for it to recover. And the truth is, you don't lose that money until you sell, right? We all know this. Unless you literally sell your shares, you're not really losing any money on paper. And the red numbers you see on your screen, well, those aren't real losses either. They're just temporary price buckets that these stocks are falling into. So if your strategy has not changed, your behavior should not change either. You're investing for years, maybe decades. So a 6-month dip will not decide your future, and it should not decide your future. Or a few days or a few weeks, none of that should decide your future. The people who end up panic selling are the ones who end up paying for it in the long run, because 99% of the times those people look back on it and just wish they would have been consistent. And one thing I like to do if I start to get nervous about where my money is use this time to actually understand what you own. Not a lot of people, and I'm guilty of it too, truly understand what they owe. Yeah, I might buy certain companies, or yeah, I might pick certain stocks, but now's the time when everything's down to really take a look at and audit your portfolio. What companies are in your ETFs? How diversified are you? What is your time horizon? The more that you understand what you're invested in, the more you get a better, clear picture in how to apply that to your overall plan, and therefore that makes you less likely to panic. And this is a great time to strengthen your foundation and just don't abandon what you've built up already. Read, learn, adjust your allocations if needed, but don't make emotional decisions based on how the market sways. Because once again, downturns will reward the disciplined and the patient people versus people who make emotional, impulsive decisions. Now, one thing I could say to mitigate some of these losses is you don't have to throw every dollar into the market during a downturn. Now, while I am, yes, an advocate for maybe even upping your investments during a downturn, if that makes you uncomfortable, keep investing consistently, but also just start a cash portfolio, start a cash position on the side if you don't have one already. That way, if things drop further, you're already ready to take advantage of it. And cash gives you a lot of flexibility. It lets you buy things when others can't, and you don't need to predict the bottom of a stock. You just need to have cash on hand ready for certain opportunities. So think of it, well, I've talked about offense and defense, right? Think about like that at the same time. Investing steadily, but staying liquid enough to pounce on something if a big shift happens or there's a stock that you want to get on because it hits a certain price. And remember, one of the most important takeaways is the market overall as a whole, right? So this is like more so talking about the S&P 500, but even if you individually pick stocks, the market as a whole is always designed to go up. It is literally built to go up over time. Inflation means prices rise. Companies, right, will raise their prices. Their revenue, in theory, will grow. Their profits will follow. And the stock price will get adjusted upward. On top of that, the US economy is constantly expanding. Yes, we're in a government shutdown right now, but that doesn't take away from the global impact that the US economy has. New businesses will always continue to form, old ones will continue to innovate, and money just keeps circulating. So as long as people are buying, building, and spending, the market's long-term direction will usually always be up. And that's why every crash in history has been followed by new all-time highs in the stock market. So it's not optimism. I'm not being an optimistic person. It's literally just math and looking at the long-term trend. And I know a lot of people don't like to look at the long-term trend or say that you can't predict where prices will go based off what's happened in history. And while I agree with that, at the end of the day, you can't argue that over the past however many years, the stock market has just consistently gone up over time. So as of right now, it's November 7th and the market is down. But if you're watching this video and it's not November 7th, but the market's down and you're feeling uneasy, just take a breath. You're not doing anything wrong. You're just living through one of the normal parts of investing that every single person goes through. And then this is when investors get tested the most. The difference is, how are you going to respond? Yes, you can panic, you can pull out, you can sell your shares and probably cut some of your losses, or you can stay calm, keep stacking and let time do the heavy lifting for you and let that compound take effect. And remember, the people who get rich from the market aren't always the ones who predicted the next crash. They're the ones who didn't quit and didn't stop investing during those crashes. So stay patient and stay consistent. If you guys got any value from this video, I'd appreciate a thumbs up and a like, and I will catch you guys in the next video. Have a good day.